Welcome to the ABA podcast, Securities-Based Lending for Banks, Balance Sheet Shock Absorber, Untapped Growth Driver. This is Phoebe Papageorgiou, Vice President of Trust Policy at the ABA. And with me today, we have Mike Musial, Managing Director of Total Bank Solutions. Mike, introduce yourself and let us know, what are we talking about today? What are these transactions exactly?
Yeah, thanks, Phoebe. As you mentioned, my name is Mike Musial. I run sales here at TBS for our securities-based lending product. And what we're really talking about, securities-based lending is a now mature line of credit in the wealth management space that utilizes a client's investments to collateralize a line of credit that they can use for anything other than buying more securities. So if they want to use it as an investment strategy, they have margin. If they want to use it for bridge financing or home improvements or college tuition or any sort of non-purpose borrowing, bridge financing things, they might use securities-based lending. And it's grown to become a very large industry with over $250 billion outstanding at the major wirehouses.
Thank you for that background. That's very helpful. Can you explain to the audience how S-blocks, as they're known, act as a shock absorber to protect the loan balance sheet and spread in ultra low interest rate environments that are characterized by excessive liquidity?
Yeah, so the main thing is they, for lack of a better term, they zig when other types of loans zag. So when demand for a certain product, a fixed product, say a mortgage or a commercial loan, may be waning, the demand for a securities-based line of credit may actually be accelerating. So a good example would be, think of a down real estate market when there are too many sellers and not enough buyers and their home prices are plummeting. Banks may not be getting as much mortgage balance sheet action as they would like, but a lot of people who are choosing not to move may be choosing to invest in their homes. So they might want to borrow against their securities-based line of credit for large home improvement projects. Or it could be after a pandemic like we just saw, and many people had their income disrupted, most loans becomes difficult with a bad credit history or low credit score, whereas a securities-based line of credit, you're not underwriting the actual borrower, you're underwriting the collateral supporting it. So it may be one of the only ways they have access to liquidity. So having a mixture of both on your balance sheet, traditional lending, fixed term lending, things like commercial and real estate lending, but also mixing in non-traditional assets like a floating rate, non-correlated securities-based line of credit portfolio can actually protect you in all different environments.
What's the market opportunity for S-blocks as a growth driver to make existing customers stickier and to acquire new ones?
So like with any lending product, the stickier, the more products you have into a client, the more access you have to their wallet share, the more they value your firm, very likely. You're offering them more services. The nice thing about securities-based lending is it's an exceptionally easy line of credit to establish. You can get these things done with the proper technology in a day or two. They're not a lot of trouble for the client. And they grow revenue in a couple different ways. The first is these clients aren't liquidating assets that they otherwise might have to solve a need, because they can borrow against those assets. If it's a short-term borrowing need, and they can pay it back. So those assets stay with the firm and they're working. And it also can be an avenue to other types of products these wealth management clients are needing. They could also need a mortgage or a home equity line, or they could maybe need unsecured credit in the form of a credit card or a business line. So having a securities-based line of credit is an anchor into a client that gives you a chance to potentially cross-sell some of your other services.
You just mentioned technology, and can you describe how automated technology has recently removed the manual intervention barriers to securities-based lending market entry and to allow a more low-cost business model for originating, underwriting, and monitoring these accounts?
Yeah, so when we first started doing these, they were very manual. So you had to fill out a blank paper application. Think like a home equity line of credit if you have one of those. And it took a long time to underwrite because there were mistakes made and you had people at every layer of every decision. And what that did is it made securities-based lines of credit a very reactive product. If a client came to you and said, I have a definitive need to borrow, you would suggest perhaps a securities-based line of credit. with the advent of technology, you can automate most, if not all, of those underwriting tasks. And something that used to take weeks to underwrite can now be done in hours. And something that used to take dozens of people to run an operation can be done with a small handful of people. And so now your cost of getting and underwriting a client is significantly cheaper than any other type of loan. Your cost of monitoring the asset for risk post-close is extremely cheap. And your ability to do this at a scale is enhanced because it's mostly automated decisioning by software. So you don't have to worry about choke points and ramping up staff as you grow your business.
Part of this technology that's automated, does any of it have to do with valuation of the assets that are held as collateral?
Yeah, that's a big one, right? So if you go to a bank and say, I'm going to give you a tool to put a lot of this on your balance sheet, but I'm not going to give you a tool to make sure that your balance sheet is healthy, that's not a really enticing proposition. So what's important to go hand in hand with the ease of offering these lines of credit and underwriting these lines of credit is a way to automate the health of these lines of credit. So a good software package is going to incorporate some sort of a dashboard that on at least a daily, if not more basis, is going to mark to market all the collateral for all these loans, track all the outstanding balances, flag any accounts that are at or near maintenance, and give you the ability to notify the client and the advisor that they're approaching or in maintenance, and even in an extreme scenario, issue sell orders to take out some of those securities to satisfy your loan.
Thank you, Mike. For those on the audience who want to find out more, how can we direct them?
Yeah, so at TBS, we built a platform that obviously does all these things we just mentioned. And if you'd come to our website at www.totalbanksolutions.com, we have a nice little write-up there about what it does and how you can request more information.
Great. Well, thank you for your time today. This was a very interesting discussion about a new up-and-coming product that's, I guess, now on the more mature side, but for a broader audience to learn more about. Thank you.
Thank you.